Ladies and gentlemen, good morning once again. Christian, I'm delighted to welcome you for the first time to the Qatar Economic Forum.
Thank you. It's been great to be here.
We're going to cover a lot of ground. I'd like to begin, Christian, by talking about investing in technology. It's one of the things that we're here to do. Everybody wants to know about artificial intelligence, don't they?
Yes, they do.
Mistral, a French company involved in AI, recently raised money at a $6 billion valuation. OpenAI has tripled to $80 billion in 10 months. NVIDIA has a market cap of $2.3 trillion, and Microsoft, which is spreading its bets everywhere in AI, is at $3.1 trillion. Christian, is there any value left in AI?
This is a great question. I think the big speculation these days is, for the companies that are doing AI, like OpenAI, how do you value those companies? There's so much future potential, but we don't yet know what the future will look like. So that is extremely complicated, actually. But I feel that this is history repeating itself a bit. If you think back to when Google was a tiny company, and it went public at a wild valuation, everybody thought, it felt like the same. Who would have known that was a multi-trillion-dollar company today? So if I look away from the valuation question, I think there's no doubt that AI is changing the world of business, the society in many ways, and that there are lots of other angles into investing into the AI space without having to deal with that particular question.
So let's talk about that. How do you play AI without playing AI?
Yeah. So across EQT, we have venture capital and private equity, infrastructure, et cetera. And we do, on the ventures and growth side, we're investing in called the tools and the shovels. Software that's serving AI, hardware that's serving AI, companies that are using apps that are using AI, and all kinds of different features around that network. And in infrastructure, we're going a totally different path. Of course, there we're part of digitizing society. So there it's fiber broadband, it's data centers, towers, et cetera, because the need for data is massively increasing. So there are a lot of other areas of investment that support this whole AI wave that's out there.
What people want to know, though, is there potential in those areas for genuinely handsome returns? Because when people think about AI and whether to commit capital to AI, they worry, not without reason, that all the value is going to accrue to the LLM developers, right? The OpenAIs, for example. Or the real arms merchants, the NVIDIAs.
Yeah, you could argue that, and I think Google itself is concerned, right? Because if you use ChatGPT, you probably do, I do all the time. That means I'm not using the search mechanism any longer. And that powers a huge part of their income, right? The whole advertising model, the interactivity, the cookies, all these kinds of things. So their business models are changing. So I think there's certainly shifts in business that are going to be impacted by this across many different types of companies and value chains. But if you look in the long term, you think the next generation now is introducing voice, video, interactivity at a scale which we've never seen before. Maybe the change that's coming is about the same as when we got the iPhone first. And of course, all the applications that are needed to handle that. And even, we also invested another angle into this, which is tech services. So primarily Indian companies that are helping companies move into the cloud or move into AI, because almost every industry is impacted by AI. Very few people have the competence. So if we own the companies that have that competence to help them, there you go.
The reality, of course, is that EQT is a $250 billion firm, and you invest not just in AI, but in technology and other areas. Let's talk about technology as distinct from AI. How do you think about it, and where are you looking for opportunities?
Yes. So if you look away from AI, we're investing in a number of different areas across the firm. we're trying to find long-term secular themes in society. One of them is the digitalization of society. The other one is, let's call it sustainability, moving to new energies, for example, as fossil fuels over time run out, and the aging society. So the number of themes that we demographics. So and that goes into the healthcare space. That's a big part of our business. The other big part of our business is technology, and there we invest in software companies across all value chains. Really, we invest in technology companies that are serving some of those sectors that I just mentioned, serving these the green space. Agri-tech is a big area, and then we have industrial technology companies, so robotics, automation. Humanoid robotics is a very exciting space. We own a company called 1X, which is one of the possible winners in the humanoid robots race. Time will tell. It's very early. So if you think about technology, it's an enormous space, actually. And what we try to do is try to find the mega trends, break that down into trends that we can invest behind, and invest from different angles into those trends.
Could you be a futurist for a moment and share with us what you think a humanoid robot is going to be doing for us 10 years from now?
I think you'll come into the Bloomberg office, and the humanoid robot will receive you in the reception, help you find your meeting rooms, serve you coffee, clean the offices when everybody's leaving, security, handling security, that kind of stuff. But also, if you break it down into another part of the world, like warehouses, for example, the robots can, of course, work 24/7. They don't get back pain or neck pain. They're strong, stable. And these are actually use cases that are already happening. All the things I just mentioned, you can watch some videos of our company, for example, or some other ones where all those things are happening. Not yet perfectly, though.
For EQT, which, as you've explained, operates as a VC investor, a growth equity investor, a private equity investor, where's the optimal place to participate in technology? Because in VC, 9 out of 10 companies fail.
Yeah.
In growth, you have to find the right time to enter. And of course, in private equity, these days, it's less about financial engineering and more about creating value and optimizing business models. What's the optimal spot?
That's the ultimate question, isn't it? Sometimes I'm asked slightly differently. What's my favorite asset class amongst all of our asset classes? And I end up actually saying, even though I grew up in private equity, I end up saying infrastructure, because if you think about the transformation that society is going through now on the digital side and electrifying the world, basically, not just the transportation sector, not just the energy sector, but over time also the manufacturing sector, and the investments that are needed, and that's in both of those spaces, or all those spaces, is massive. And you're providing essential services to society, and then we add the venture capital, private equity mindset to it, so we can expand those companies, create better services, et cetera, and better companies. So that's probably what I'm most intrigued about right now.
Europe is EQT's backyard. You live in Zurich, in fact. Tell us, is what's going on in European technology, competitive with what's going on in American tech?
No, it's not competitive with American tech, and that is something which is a challenge, a big challenge. If you look at there are no trillion-dollar companies in Europe, particularly not in tech. We're quite good at life sciences, pharma. Novo Nordisk, for example, is a fantastic company in Denmark, right around the corner from us. But in technology, it's an issue, and I think that there are multiple levels of problems. It's access to capital. It's different regulatory regimes across countries. It's possibility for exits, and it's like the Silicon Valley, of course, is the ultimate example. There's a value chain there from the early startup angel investors all the way to the public markets, and in the universities, and everybody's working to get that company up. And since Europe's so fragmented, you don't have anywhere where that's really successful. Sweden's pretty good at it, actually, where our company is from, but it's a fraction of Silicon Valley.
Does Europe recognize that it has this problem?
Yes. We're part of a big delegation in the EU that was led, actually kickstarted by President Macron in France, to help attack some of these areas. So mobility of labor, mobility of capital, creating, rather than every country having a stock exchange, shouldn't we have a European stock exchange?
A federated stock exchange.
Like a big one. I mean, we're traded on the NASDAQ, but that's NASDAQ Stockholm. Why isn't that connected to the rest of Europe, you know? So, so all these elements, and actually when we were doing that study, which was 2 years ago or something, the majority of capital into growth companies was coming from America, and the majority of exits above a certain level were in America. So if you don't have the capital, you don't have the exits, of course you're losing a lot of the value creation. That's not good.
What about regulation? The European Union, as many of you probably know, has GDPR, it has the Digital Markets Act, it has the AI Act, it has many other pieces of legislation. Is Europe over-regulating tech? Is that partly to explain for this lack of competitiveness?
It may be, although there's a lot of regulation in America as well, as you know, and there are tariffs being implemented and all kinds of trade barriers and stuff. So I think this is a global trend, unfortunately. But the fact that Europe is so fragmented, that I just talked about, and you put regulation on top of it, of course, that makes it harder. I think if you compare the Green Deal versus the Inflation Reduction Act, it's really interesting. So we did that, actually, a few months ago. And they're not that dissimilar in size, but the IRA is much more effective because it actually provides cash, it deregulates, and it's quick. And Europe has the problem that they have the same ideas, but you get credits instead of cash, it takes longer, and regulation is harder to, let's say, harder to weave through. So there is an issue there, yes.
Christian, I suspect there may be some of your LPs in this room right now, and they recognize that private equity has a bit of a problem. It is difficult to exit investments and return capital to your limited partners. How are you solving for that problem?
Thank you. We have actually more than 10 years ago, we started shifting our mindset in private equity and how we manage our funds to make sure that what happens in a typical private equity fund is they end up at the end of the life with relatively few companies that are underperforming and are hard to exit. And then
you got out of all your good ones early.
So it's the opposite of financial theory. You sell the winners and you keep the dogs. So we switched that around, which our industry has been slow to do, but we did it. So we run with the winners and try to sell the dogs, rather, if I may use that expression. And that means that we were lucky coming into this cycle that we've sold a lot of companies. But what we're doing now is trying to innovate. So first of all, we built a team around exit so we can be the best at providing the markets with healthy and good IPOs. We just took Galderma public in Switzerland. That went very well. So we can actually really make sure we understand which companies should go to the stock exchange. How do we do that in the best possible way? How do we create long-term success? And of course, all the different private avenues to families, to industrial groups, to financial groups, et cetera. And then we're also trying to innovate with something we call private IPOs, which is kind of, if you think about it, pretty simple. If a company here is going public, you make a market in the shares, it starts to trade. We could just keep it in our ecosystem, create a market in the shares, and continue to run with it. So this is something we're trying to do this year, together with some of our big clients, and hopefully that'll create yet another alternative to create liquidity, because there's a lot of capital. There's $10 trillion in private markets. We have more than 1,200 institutional clients at EQT. In a typical IPO, there's only 150 or 200. So why couldn't we do that?
When I read about that for the first time, I thought, what a clever alternative to the continuation fund.
I agree.
One of your companies, Waystar, which simplifies healthcare payments, is trying to raise $1 billion in a US IPO. How important a test for the IPO market in America will that be?
I think it is going to be important. There haven't been that many IPOs yet, maybe 10 or 20 or something like that. Luckily, I think they've performed reasonably well, with the exception of a couple. And this is a sizable company, you know.
Pardon me.
$5, $6, $7 billion, whatever it's the valuation ends up being. So it's sizable. It's in a really interesting sector, and a $1 billion IPO in the U.S. is pretty big, actually. So I think it will be important, and ref my other comment that we're trying to be really, really good at this and think very long term, because when we take a company public, we're typically owners of that company 3 more years. So we're doing our best to make sure that that goes well.
Sovereign wealth funds in this part of the world, the QIA included, of course, have become very important partners for firms like yours. I had the opportunity to speak to Mohammed Al-Sawaidi, who is QIA's CIO for the Americas yesterday, and he was talking with some sense of satisfaction about how much leverage investors like QIA have over their GPs these days. Is that something you feel acutely?
That's a good way to ask the question. I'd rather say that it's pretty impressive what this region has been able to create in terms of capital base, growing populations, growing economies, and a real willingness to invest in innovation in the future, whether it's infrastructure locally or whether it's global companies, et cetera. So we're lucky to have partners all over the region, and we try to work with them in funds and direct investments and create a partnership spirit, I think is the way I would say.
EQT has taken some pains to distinguish itself from the rest of the private equity industry. How will you distinguish yourself further in the future?
It's a good question. Again, the way I would answer it is that we like to go our own way. So if you look at EQT today, all of our strategies connect with active ownership. We own shares in the company, or we own the building. We own typically co-controlling or co-controlling stakes. So when you have EQT as a shareholder, there's something happening. We're helping drive transformation, driving that company to the future, driving change. Sometimes things are tough. We need to fix those problems together. We don't have any passive financial products. So we don't have any insurance products. We don't have any credit products, those kinds of things. And because that's a totally different mindset. That's an allocation mindset. It's an AUM game. And some of our peers are playing that game. That's not for us. We're here to create the most value that we can in a responsible way. And we're in the performance game, rather than the AUM game.
One of the ways in which you've distinguished yourself is by being a willing buyer of businesses that help you enter new markets or perhaps new products. In 2022, EQT made the then largest ever purchase of a private equity firm, if I'm not mistaken, BPEA in Hong Kong, for north of $7 billion. Since then, of course, BlackRock has bought GIP, an infrastructure company, for $15 billion, so that's bigger. But I'm curious to know, and I think people here might want to know, do acquisitions remain an important part of your strategy, and how healthy is your appetite?
Yeah, it will. I mean, you look at the whole industry, there are something like 7,500 PE firms in the world. And there is a consolidation ongoing, driven by some of the forces we've talked about, and also driven by the need for, you need a lot of competence around AI, digitalization, sustainability, reporting, compliance, regulation, you name it.
You get that from scale.
You get it from scale. And if you're small, that's going to take way too much time. Rather, join a big platform. We already took care of it, and then you can just continue investing. So the consolidation is going to continue big time, and some will be outcompeted. I think this next cycle is going to be pretty tough. The tide was rising all boats from 2010 to 21. Now it's back to fundamental value creation. So we think we will be one of the consolidators, yes. I don't see that many deals of the size that of BPA and GIP. There aren't that many firms of that scale. But I think, regional or niche players in certain areas, specialists, certainly will join forces with us, and will continue to grow.
Ladies and gentlemen, Christian Sinding.